Advanced Financial Accounting. In this presentation, we're going to take a look at a practice problem related to a consolidation where we have a parent-subsidiary relationship, the parent owning less than 100% of the subsidiary. So they have a controlling interest. We're still going to be doing the consolidations, but they don't have a 100% ownership of the subsidiary. So that's going to add a bit of a complication within our consolidation process. We also have a situation where the fair value is going to be different from the book value for certain assets, such as property, plant, and equipment or depreciable assets. We'll have to deal with that difference as well within the consolidation. We will start off doing this in this problem as if it was year zero. In other words, we're going to say that the purchase took place to get that controlling interest and then take a look at a consolidation right after that time period, not considering then any temporary or income statement accounts at this point. And then next time we'll take a look at years out so that we have activity on the income statement, which will add a bit more complication to the problem. Get ready to account with Advanced Financial Accounting. Here is our information. We have P purchased a percent of on December 31st, 2000 X0. So that's going to be at the end of 2000 X0, the percent being 70%. So that's going to be one of our key differences from prior problems, not 100%, but a 70% interest, meaning we're going to have a controlling and non-controlling interest we now have to deal with. The amount paid was $89,600. The fair value of the non-controlling interest is $38,400. And then this is the other key difference that we have here as well. So we got the book values of assets and liabilities the same as the fair value, except for the fair value of other assets is $84,000 and the fair value of the building and equipment is $203. In other words, if we take a look at our data at the point of purchase, which these two trial balances represent for P and S, we're considering S's books here. Looking at other assets, they have $78,000. We're saying fair value now $84,000. And then we have the building and the equipment here, which is the $261 on the book value. They're saying it, well, actually, you got to subtract these two out. So the $261 minus the accumulated depreciation. You do want to be careful about that. Make sure you're looking at that properly. So the $261 minus the $73,000 would be the book value, and the fair value is now the $203. So that's going to be our two major differences that are going to cause us more problems at this point in time. Then we have the intercompany AR and AP. So we've seen this in the past, meaning that, for example, P has a receivable from S, and S then reflects the payable from P. So that not new, but we're just adding a little bit more complexity. Note that many things in accounting, a lot of times if you were to take them in isolation, nothing is all that difficult, right? But when you start putting them all together, then just how will you approach so many different things becomes more difficult. So then we have the consolidate financial statement just after the purchase. So we're going to do the consolidation just after the purchase, meaning the purchase took place on December 31st. We're consolidating right after. Therefore, there are no income statement accounts we have to deal with. We're just basically consolidating the balance sheet right after the purchase period. Let's first consider our calculation for any goodwill that might be involved. So remember, what you want to do first of all is obviously line these things up. We got P and S. Then we'll consider adding those two, and then we want to consider how is this account, how is this account being accounted for, the $89,600, and then consider the revaluation and whether there are any goodwill, because that will be reflected within basically the investment account when we create the investment account. So let's consider the goodwill type calculation. So we're going to take the book value of S. Now, since this is the point in time that we actually did the consolidation, we'll pull out the giant calculator. We could calculate the book value of S, which would simply be the assets minus the liabilities at this point, assets minus liabilities, or the equity section at this point in time. Because this is the same point in time. Remember, we're 31,000 plus the 76,000, that's the 107. Or we could take the assets minus the liabilities and would, of course, get the same number. So there's the 107. Then we're going to take the fair value, which is the over the book value of the 21. So let's calculate that real quick. So I don't know why I put the calculator away. We got to pull it back out here. We're going to say then that if we take the other assets, so we have 84,000 and the 207 or the 203. So we've got 84,000 plus the 203,000 minus what is on the books for, which is other assets 78,000, and the little bit tricky here, minus the building and machinery 261,000 plus the 73,000. That's going to give us the 21. So in other words, we're adding this number plus this number minus this number, and then adding these two together, and then subtracting those two totals to give us the change, which is going to be a $21,000 increase in the fair value over the book. That means the fair value then, if I was to revalue this thing on a fair value basis for S, would be $128,000. And then we're saying that we have a 70% interest. Now, you'd think you'd say 70% at this point would be the amount that we would value it at, but they're saying that the non-controlling interest, if you're given, in other words, the data of what the non-controlling interest is, then we're going to use that. We're going to say, hey, look, if this was 100% on a fair value basis, I'm going to subtract out the non-controlling interest, which is given to us at that time, the 38.4, that then giving us the fair value of the controlling interest, which represents what was purchased, the 70% interest here that we're talking about at the date of purchase. We're going to compare that to the amount paid, which was the same, 89,600. Therefore, no goodwill we have to deal with. So there's no goodwill we have to deal with. However, we do have to deal with this change in the fair value versus the book value during the consolidation process. Okay, so then we think about the consolidation. We've got P's books. We have S's books here. First thing we're going to do is sum them up, just as we have seen in the past. So now we're just going to add them up. This will be our total for P and S at this time. Then we'll take a look at our consolidation process. Including accounting for this investment account, which we hope is going to go to zero at the end of the day, removing, in essence, the common stock over here. And then we have this new account we'll have to be dealing with, the non-controlling interest in the net assets of S, representing the non-controlling interest. So the investment account, I'm going to put that up first. I'm not going to calculate it right now. We might go back and calculate it in a second. But right now, I want you to think of it as kind of a plug. I put that there first because it's kind of the first account that you think of when you do the consolidation. So I want to pretend the number isn't there yet. I just want to note that I know I'm going to credit that for some amount. You could, once again, do this with one long journal entry, which I think is beneficial in some ways. But I also want to break them out into smaller entries so that we can put them into chunks as we go forward. And then you can regroup these entries as you see fit to better understand how this all is put together. So then the next one is going to be, we're going to remove the common stock for S, similar process. Notice we have a non-controlling interest, but that doesn't mean I'm just going to take part of S's interest off the books. Notice I'm removing the entire thing, and then I'm going to be reporting the non-controlling interest in another account. So this is the same process as we would have, in other words, if it was 100% owned in essence. So in other words, we're taking off the 31,000 for S, so 72 for P, 31 for S, 103 for the total. Then we're removing S to get back to P's, 72. We're going to do the same for the retained earnings. We're removing S's portion. It's a credit here, therefore we're going to debit it up top. So we've got the 205 plus the 76. That adds up to the 281. We're going to remove S's portion, the 76, giving us back to the 205. Then we're going to think about the non-controlling interest. So now we're going to put on the books the non-controlling interest. How would we get to that? Well, this stands for non-controlling interest in the net assets. So if you were to think about that, or you're going to say, all right, the non-controlling interest of the net assets, if I was to basically pull up the trusty calculator and take a look at the net assets, which you can calculate as assets minus the liabilities, or if you're just taking the equity section, we could just take the 31,000 plus the 76,000 times, and we said that the non-controlling interest will be 30% because the controlling interest was 70%. So then the non-controlling interest must be 100 minus the 70 or 30%. So times the non-controlling interest, 30%, 0.3, 30%, that's the 32,100. So there's the 32,100. So you can calculate that as adding up just the equity, or if I was to add up assets minus liabilities times the 30%, same thing. So that means that you can think about this 74,900 as the plug, In other words, the 31 plus the 76 minus the 32,100. Or you could think of it basically that's the controlling interest, right? Because the controlling interest has been included in this number with the calculation of the equity method. So in other words, if I was to take this 31,000 plus the 76,000, we're basically looking at the book value of S and allocating it between the controlling and non-controlling interest. The controlling interest being reflected in the investment account. Now, it's not going to be exactly what is in there because this is going to be affected or changed by the fact that there's a book value and fair value difference. But right now, we're just considering the book value that's been reflected in this equity account. So if I take that amount times the 70%, 0.7, that's where we're getting the 74,900 times the 30%. That's where we're going to get the non-controlling interest, which we're just going to say in one line item down here. Hey, look, this is the non-controlling interest portion down below. Okay, so then next thing we're going to have is that the other assets we're going to have to change. So you'll recall that the other assets here, the 76,000 for S, needs to be increased because the same point in time, as of this point in time, because this is the same point in time that the purchase took place, the fair value was $6,000 higher. So I'm going to increase that by the 6,000. So in our consolidation, we show it at basically the full amount. Now notice again, we're not taking 70% of the 6,000. We're not saying, hey, I'm just going to report, the P's portion of the 6,000. No, we're reporting the total increase in the assets here, showing the assets and liabilities reflected at full fair value, at the full value here. And then we're going to be showing the non-controlling interest, down below. So we're going to have to adjust that. Then the other side, building and equipment was also increased. So the building and equipment is going to be going up by the 15,000 because the fair value was higher than the book value by that 15,000. The other side then, these are two balance sheet accounts. So the other side is going to have to be going into that same split. The other side then is going to be going into the investment account because it's already been reflected in the investment account because this investment account went on the books based on the fair value, not the book value, but 70% of it, right? So we're going to have to be increasing the investment account, and then the rest is going to be adjustments to the non-controlling interest. So now we're adjusting S's books based on this fair value adjustment. So in other words, if we took this 6,000 plus the 15,000 times 0.7, there's that 14,007. And if we took this 6,000 plus the 15,000 times the non-controlling interest 0.3, there's the 6,300. So we're going to increase the total assets. The other side's going to be reflected in the investment account here, bringing it down to 0. And then we're going to record the difference here in the non-controlling interest. We had to now adjust the non-controlling interest for that change that took place to basically the equity section there. Now, that's going to be our major adjustments. So we've done our major kind of adjustments for this at this point. Note again, the new thing that's happening here is this non-controlling interest. It's not too complicated right now when we don't have the income statement. We'll add to more complications later because when we have the income statement, we'll have a non-controlling interest account, not in the equity, and then one on the income statement we will have to deal with. Also note that, of course, when we deal with something like the building and machinery, it will be changing the calculation for depreciation, which we'll have to deal with going forward as well. And as we consider that change to the income statement accounts in the future, we will once again have to break out that change between controlling and non-controlling interest on the income statement side of things, which we'll do in future problems. Also note that you could put this whole thing into one journal entry. It might make more, it might make more sense to you to just try to remove this entire account up top and then account for, all of these differences basically in one journal entry. It might, but breaking it out, and you might group this thing in different ways that might, make sense to you as well. So, and you might want to do that because it could help you if you could see this thing in different kind of formats. It probably means you're getting a better grasp of it. So I would turn it around and I would do that using Excel. Now we're going to be doing the standard kind of adjustments we've seen in the past, meaning this 73,000 in accumulated depreciation. I want to net that up into the book value here. as kind of like a sale took place within our consolidation. So it's on the books at 73,000 credit. We will then debit it to make it go down. And then we're going to be crediting the building and equipment, basically netting those two out. So we basically net those two out. And then we have that intercompany transaction between the receivables and the payables. In other words, we're saying that P, if you looked into the receivable subsidiary ledgers by customer, reflects a payable that's owed to them from S. And if you look at S's payable subsidiary ledger broken out by vendor, it shows that they owe P. So now that means that the receivables and the payables are overstated when we do our consolidation. The net capital or equity will be okay, but overstatement of assets and liabilities, therefore we remove those and we'll simply debit the accounts payable, reducing the accounts payable, credit the accounts receivable, reducing the accounts receivable. Again, we've seen that in the past, so I'm not going to spend a lot of time on it, but just note that like many things in accounting, I know I mentioned this a few times, but just note that none of these concepts are all that difficult, but when you start to pile them back up on each other, then part of the difficult piece is going to say, okay, how do I want to approach this? Which thing do I want to do first, second, third? Which things are related together? And which things can I pull apart and do basically separately so I can see what's going on one piece at a time. So just being able to take some of these other things that we've seen before and break them out and do them in the proper an order that makes sense to you to be able to break that out is useful. So note that this first two journal entries are the main kind of consolidation journal entries that you want to think of, how you're going to group those together, and you should be able to kind of pull those apart and then do the other kind of adjusting entries that you need to do and be able to kind of break those out separately. So what kind of things are connected, what kind of things are going to affect each other and have a problem, and therefore we have to do them in some order, and what kind of things are things that I can kind of pull apart and do them, look at them in a vacuum or in and of themselves. Now then, if you were to take this information and now you got your consolidated trial balance and make like a balance sheet from it, this is just a really quick balance sheet because it's all the same stuff, except the down below in the stockholders' equity. So the assets, if we were just to add up all the assets, we got the total assets, we got the total liabilities, and then the interesting component here is the stockholders' equity, which we can break out to the controlling interest, which now we're pulling in the 72 and the 205. So here's the 72 and the 205 for the controlling interest, adding up to that 277. And then we'll pull in the non-controlling interest, which of course is that 38.4. So there's the 38.4 to total up then to the total equity of the 315. Equity plus liabilities, of course, matching up to the assets at the 1,017,700. So just notice kind of logistically, we basically said, all right, we've got P's books, we've got S's books. We basically combined them together, all these accounts, assets, and liabilities combined together the totals, right? Because remember, what's really happening here, who is this for? It's for people who are interested in P mainly. So you might think, why don't I just represent assets and liabilities to reflect 70% of S's books? Because, this thing is pretty much geared towards people that are interested in P. But that's not what we're doing. We're saying, hey, I'm going to represent the entire books. Why? Because P, although doesn't have claim to 100% of the assets of S, does in essence have control over it. So we want to say, hey, look, this is what, ultimately the buck stops with P because they kind of have control over how to use these assets in order to help generate revenue. And so we want to measure performance on how well they did on that when we start looking at the income statement. And then and so we basically combined them together completely and fair valued it at that point in time. Then down here, we said in the equity section, we're going to say, even though, you're basically saying, even though P has control over how to use the assets and liabilities to generate revenue, if they don't have claim to all the assets and liabilities. There's a non-controlling interest, which means kind of like you can think of if they were to liquidate, then not all the assets would go to the P stockholder. There's a non-controlling interest, and that's that non-controlling interest that would be shown here. So in essence, again, you might want to think about that in terms of almost like a bondholder, right? In terms of a liquidation process, there's claim to the net assets to non-controlling interest, non-shareholders of P of this amount that's represented in the equity section.